And here to talk to me about the latest CPI inflation report is Mark Hamrick, Senior Economic Analyst at Bankrate. So Mark, headline number 3.7 for the year, 0.4 for the month. Just to start off, what has been your initial reaction at this time?
Don, good to be with you. We look at these numbers through a number of different lenses. And I think, we think essentially about the shocking aspects of inflation that have been with us over the last couple of years. The good news is that inflation has come down from its peak. The headline number on this consumer price index was a little hotter than expected, and that translates then to the year-over-year increase of 3.7%. The core rate year-over-year, excluding food and energy, up 4.1. So what can we take away from that? First of all, obviously well down from the peak of June of last year, 9.1%. That's falling a long way. We still had some contributors here, including the cost of shelter. There is some statistical wonkiness about this, that what's going on in the actual marketplace may not filter on through to the numbers. So we kind of set that to the side. We had contributors in the energy sector, both with gasoline and electricity prices. And it's interesting, the year-over-year increase in food prices is exactly the same as what we're seeing with the headline on the CPI. So backing away from all that, inflation remains unacceptably high, but it's moving in what one might say is the right direction, but it's not where most people want it to be yet, and that includes the Federal Reserve, which of course has a 2% annual inflation target.
So rent in the real world has been coming down in the past few months. Perhaps that hasn't reflected yet in the CPI report. Right. So what I want to ask you is, what is the trajectory of inflation right now? I know it's come down from the peak, as you mentioned earlier, but the last few months, we haven't really seen significant movement in either direction.
Yeah, and that's been exacerbated by the recent uptick in gasoline prices. Energy prices have been somewhat sticky. And we think, Don, about the fact that, we really do require energy and transportation to sort of do the business of the economy. And so to the extent that up until recently we were seeing rising gasoline prices have actually fallen rather significantly of late, but we don't really have a good handle on what's going to happen with oil prices given the war in the Middle East now. So I think the outlook remains, whether it's our new quarterly survey of economists at Bankrate or what the Federal Reserve's summary of economic projections contain. We're looking for inflation to continue to come down, but it could be 2025 before it actually sort of sinks into that Federal Reserve 2% inflation target. I think people probably feel broadly as if they can deal with an inflation rate of 3%, much better than the sort of much higher than that readings that we were getting, let's say, last year.
Would you categorize that as inflation hanging around for longer?
Yeah, it's, the great Benjamin Franklin in our country once said that fish and visitors stink after 3 days. I think that you could say maybe the same about inflation when it's elevated. And I do want to point out that, for example, on that headline number or the core number, again, headline 3.7 year over year, 4.1 with the core, well, that's below what we saw in the September employment report in the sense of the increase in average hourly earnings, which was 4.2%. So if we're getting wage increases that are now, very slightly, and we're talking about essentially the entire workforce, outpacing what's going on with the increase in prices, then that's welcome. But we also think about the fact that it's more like, sort of exiting the hospital after having been in recovery for a while. We still have some work to do with respect to restoring balance with respect to budgets, whether it's on an individual or household basis, or even the impacts of inflation that are on enterprises. There was recently a survey from the National Federation of Independent Business, the trade group that represents small business, and they identified inflation as continuing to be their number one problem. And that's just indicative of how that weighs on everybody.
Yeah, right. And maybe we can talk a little bit about market reaction as well, if you can comment on that. So we had the PPI inflation number yesterday, actually, and it also came in hotter than expected, but we didn't see a huge sell-off in markets. Do you think it's going to be the same situation with today's report?
Well, I don't really make it a practice, Don, to sort of make prognostications about financial markets simply because they can reflect a lot of things that are aside from what the economic fundamentals are. But to the degree that investors are taking this in stride, I think it reflects, first of all, what's been going on with bond yields. Not necessarily the kind of thing that we would talk about. It would be tailgate parties ahead of a football game in this country. But bond market yields are important because we have what the Federal Reserve and central banks set, and then we have essentially what financial markets participants set. And what we had seen over the past few weeks was a steep rise in those bond yields. And that translated last week to the average for a 30-year fixed rate mortgage, as we track it at Bankrate, going up to 7.80%. That was the highest since the year 2000, and that really does weigh on housing activity, just as one benchmark. So I think that financial markets participants, investors, if you will, can take some of these CPI and PPI numbers, even when they're coming in a little on the hotter side, in stride, because it doesn't necessarily translate to a big pivot in a more aggressive sense on the part of the Federal Reserve. I think that right now it's really an open question whether the Fed hikes at the November 1st announcement and meeting. But I think that right now people are sort of saying that may not happen, even though at the previous meeting they signaled that they thought there was a likelihood that rates could rise between then and the end of the year.
Yeah, I think you're right. The narrative perhaps have shifted a bit from the Federal Reserve. I mean, do you think the Fed has found the right balance between over-tightening and not doing enough?
Ultimately, Don, that's a question that can only be answered with the passage of time. And we've seen in the past where it looks like things are fine with respect to what the Fed does. And let's think back to earlier this year when we started suffering a mini bank crisis and some massive bank failures that were really perhaps at some level predictable, but also unforeseen. And I'm not predicting a resumption of that, but I'm simply saying that much the same as the Middle East war, some simmering issues can come out of the shadows and come back to bite us. So I think for now the Fed is probably thinking that it has it close to right. And what I think some of the things that contribute to that is when Chairman Powell talks about the risk of doing too much being balanced against the risk of doing too little. And when they sort of get that at basically at parity, then they're starting to feel comfortable. And of course, then the question arises, which we can all sort of anticipate at this point, what is the future direction or level of interest rates? And that ultimately is perhaps the most important thing. And so we just published a series of stories written by my tremendous colleague, Sarah Foster at Bankrate, talking about what we found in a survey of economists. It's our quarterly survey. And they did say that they thought, collectively speaking, the Fed could start to lower interest rates next year, even as inflation kind of remains on the higher side, going on through the end of 2025, when they see it sort of settling into that 2% level. So we think about, for example, that benchmark rate of the Fed's, essentially, if you take the midway point at 5.375%. That's well above the current rate of inflation, however you measure it. And so that rate is restrictive. And to the degree that if we see further declines in inflation, then that means that essentially that is a tightening because the level is higher than what the inflation rate is. And while that sounds very sort of technical, it's actually kind of simple. And the Fed looks at that, and if one pays attention or listens to the news conference that Chairman Powell holds, he will talk about sort of the real rate and the fact that it is now in a restrictive territory, and that means a lot, because we know what it's like when the Fed keeps interest rates remarkably low. We've been through a lot of that over the past 15 years or so, including during the pandemic and up until March of last year. And we know what happens when rates get tight, and that has impacts on particular sectors of the economy as well as financial markets.
All right, just one final thing, and it's do you think we're going to have a soft landing?
That is the multi-trillion-dollar question, isn't it, Don? I think the odds favor a soft landing right now. The unfortunate thing is we can't really predict the future and all the events that could influence that, including this war in the Middle East. And people might say, well, how do you connect the dots to that? And if you have a widening conflict, then there's increased risk that oil prices spike. And we've been down that road before, unfortunately. But we did, as I said, just survey economists on this, and it's interesting in the sense of collectively they put the odds of a recession over the coming 12 months at basically a 4.6 in 10. Okay, so that means that they're saying it's not quite even odds that there is a recession, but I think more importantly, that is the lowest that they put those odds at 46% since the first quarter of last year. So I think the takeaway from that is the risks of recession remain elevated, certainly far from a sure thing over the next 12 months. But I also want our listeners and viewers here to think about it in another context. The economic cycle is real, meaning that we go through periods of expansion and we go through some periods of contraction or recession. Some of the past two recessions that we've had in the United States, as for example, benchmarked by the unemployment rate, had an unemployment rate of 10% in October 2009 and 14.7% in April of 2020. Those were extraordinarily painful recessions, even though the last one was very short, but was also sharp. So the next one need not be nearly as severe, but like everything else, we'll have to wait till we get there before we know what that actually feels like.
Right. I mean, I think a lot of analysts would agree that eventually the U.S. economy will have to face a recession, but it's only a matter of time. It could be 10 years, could be more, could be less, but a recession is something part of the cycle. But thank you so much today,
Yeah.
Mark. Pleasure speaking with you.
Good to be with you, Don. Thank you for having me.